Please switch off your volumes. We start today's market talk. At the end of the day, good investing is about paying less than what something is worth, preferably if it is a great business with good management. So good investing should be boring. Don't cave into FOMO as what is prevalent right now. Do your own diligence. Master financial statements. That is very important because what the statements tell you is what the companies hide, and there are more moving parts than what most people think. Now, coming to market outlook, firstly, Nvidia Q1 is a solid beat, raised guidance for the next quarter. It drives stock to all-time high, and it's very interesting. Today morning, I was discussing about Nvidia. Uh, EPS growth was spectacular, rising 629% year on year and 21% Q on Q. Right now, there is no alternative to NVIDIA's chip architecture. They raise revenue and earning guidance. Competition between mega tech companies to build data centers will keep demand of NVIDIA chips very strong. And as a big surprise, NVIDIA's forward PE is only 38. Right here in India, a company which has just got narrative is trading at 380 PE and all that. And company's newest accelerator design called Blackwell can run 4 times faster than current chip architecture while processing AI learning sets. So Nvidia will keep driving the US markets or Nasdaq at least. Now, the other thing which happened was RBI announced the highest ever dividend of 2.11 lakh crore to the government of India for FY24. So this windfall payout to the government improved the fiscal position, raised probability of lower borrowings, led to rally in bonds, that is the GSECs. Now, government can continue with increased allocation to roads, railways, defense, etc., which will boost earnings and justify valuations or higher valuations of these stocks. The flash composite PMI for India for May, a yardstick for private sector activity in the economy, came at 61.7 compared to April's final reading of 61.5. Now, this is very strong growth momentum. It indicates corporate India is not worried about result of ongoing general elections. Now, a good win for BJP oblique NDA will likely lead to a short-term rally, but focus will eventually return to macros, earning growth, reasonability of valuations. After the elections are over, it is finally up to the government to drive the next phase of structural reforms. So finally, the stability will come to prices. Now, strong growth in orders, improving visibility, execution, and earnings augur well for HAL. Earning guidance remains strong on the back of current order and execution. 18% growth in operating income, 82% in EBITDA, and 52% in net profit. FY26 expected EPS is 136. That is that right now this stock is at around 36 PE only, and they have an order book of around 91,000 crore and expected to go up. In fiscal year 2024, exports are just 1% of the total revenue, but there is a possibility of big improvement. So at present, the government is the only customer. Now, the interesting stock is Siemens, a vertical split of Siemens Energy, and its listing will sustain investor interest in the parent company shares despite high valuations. They are also selling their India wind turbine business at approximately $1 billion. And they're going to demerge the Siemens Energy from Siemens Limited, that is the parent company, on 1:1 ratio. So this will keep this stock excited for next few quarters or so. Now, this is the technical chart of government bond 10-year yield. So if you see, I'm showing it from 2019 onwards. So generally, what used to earlier happen was that the bond yields used to move between 6 and 8. Now, here after this, it had corrected down during COVID, and then it had risen up, and now it is on a downward trajectory. It broke around 7%, and with lower borrowings and lower demand for bonds and inclusion of bonds in the various JP Morgan and Bloomberg indices also, this bond yield is expected to fall. It's on a downward trend line now. So this is going to fall, and all the gilt funds, all the GSECs which are traded will do well, not the one which are held market to market. But this will help all the PSU banks because their treasury gains will improve. Now, coming to the US, there is a growing sense of uncertainty over expected interest rate cuts by Fed. Latest Fed minutes, coupled with cautious commentary from Fed speakers and unfavorable economic data, dented the sentiment. Actually, unfavorable economic data is a strong economic data. Now, Nasdaq went up due to surge in Nvidia, and Dow fell minus 2.3% for the week. Their flash PMI came at 54.4 in May. In April, it was 51.3. That led to a sell-off in US equity market because that rate cut scenario was delayed. So now if you see this 10-year yield, it was correcting. Then it started going up as the economy started showing strength. Again, there was some weakness, and a point about early rate cuts in maybe September and one in December. But now the latest data, so if you see the bond yields were again up last week. So right now it has to break this. If it breaks this declining trend line, then again an uptrend will start. So the impact was, if you see dollar index, it had a green candle. It is at 20 EMA. So it is again, but still it is above the declining trend line. So if it remains up, again the impact on the commodity prices, the impact on the currencies of emerging markets will again start. Now the Brent crude, it corrected last week, so it has come down to that declining trend line of around 80-81 level. So we'll have to watch this issue. This is a very interesting thing, and it is correcting basically because there is lack of demand as such, despite so much of geopolitical issues. Gold again corrected now because the dollar has strengthened. So the gold which had gone to 2400 has come down. So it is expected to correct, but till the time it is above this 20 and 50 EMA, it will remain in positive zone, and any news of rate cuts or something like that, it will again rise. Nasdaq, if you see here, the chart from 2022 onwards, so it has broken through the rising trend line, and it is at all-time high, and this last move is powered by Nvidia. So this is the only index out there which continues to be strong. Now this is copper. So I introduced now copper here for the first time. So if you see, it was declining, and then based on supply constraints and all that, it went up. Now last week it corrected. There was some profit booking, but copper, there is a basic problem, and it will continue to perform well. Only thing is that this is the trading moves which are taking place. It had gone up too high, so it had to give up something. But be aware of this. Copper as a commodity. Sorry. Now India VIX, last week, this is a daily chart. It is consolidating now. So this time it has not really gone that high. It used to go to 30% normally during elections, but this time it has stuck around 2021 or 22. So it is consolidating. So let's see which direction it goes from here. Nifty 50, this is a weekly chart. So if you see this, firstly, it is a rising trend line. So it is not making any lower lows or lower highs. Second, it has made a fresh high, reached approximately 23,000 level, and has gone above this red candle level from where it had corrected. So that is a big positive. And this is the one which is leading this rally. Now we will see the Nifty on daily chart. So if you see here, this was the top which it was forming. So that it has broken out above that. So now this 22,800 level would be the key support, and it should take support here. And now if you see here, from 22,600, it had nearly a 400-point rally. So for a good rally, which is technically strong, it should correct a bit, retrace a bit to around this 22,800, 22,850 level and then assume. So that will be a strong rally. But otherwise, if it just keeps rising, then the fall will also be very steep. So some amount of 50% retracement is essential for sustenance of the rally. And we have seen over the last few days, this 21,800 level is a decent support now. So double bottom has been formed. So that is good. And it will continue to do well right now. Now, this is the hourly chart. So if you see the low which it had formed, so if you do a Fibonacci extension from the low to the high of the last 2 weeks, you will see that the first targets very conservatively should be 23,300 and 23,500, which is 23.6% extension. Sorry, this is extension actually, extension and 38.2% extension. So these should be immediate targets, which should be possible in case there is some buying and short covering. Now, Nifty Bank, just why I wanted to show, it has yet to cross this level of the high of this big red candle, which had brought it down to 20 EMA. So it has to cross this 49,250 level for it to get some momentum to go to 50,000 plus levels. So this should be the level to watch out for. Once it breaks out above this level, then it should do well from here. So this is the key level to see. Now, if you see here, Nifty Bank, we had 4 trading days. So out of them, it had 3 positive trading days. Otherwise, it took support at the 50 EMA and rebounds from there. So we'll have to see which direction it goes from here. The bounce was basically due to HDFC Bank. So if you see the daily chart, from the high, if you take a declining trend line, it has on Friday, it has broken through that. So hopefully it should do well. Now it has come to the resistance of 200 EMA. So once this 1520 level gets crossed, then we can hope for further targets of around 1550 plus and all that. And after that, this gap has to be filled, which it had made. So we'll have to see. It all depends on FI buying and all that, whether they do buying in this. Now, Reliance, if you see here, Reliance has this is a supply zone here from 2950 to around 3050, sorry. So this is a basic supply zone where it has made number of times it has gone there and sold off from there and then gone down and taken support at the nearest moving average, which was 2840 here, and then again testing that. So this zone has to be crossed, and I think it will require a major trigger for it to cross this zone, which would happen mostly post-elections, in case they do a hike in the tariff rates and all that. So now the stock which was in good momentum was BL. This is a weekly chart. So if you see, it made a very strong green candle. Mostly this stock was performing well. It was rising along the 20 EMA. So it was very comfortable rise and there was no need to sell this stock or it be getting overbought or something like that. Now, if you see here, moment it goes above the 20 EMA, it starts becoming overbought. Then it dips below that, comes to the 20 EMA for support. The RSI comes below 70 and now again. So now it is grossly overbought and it can't be bought right now, and it will face resistance at this round figure of 300 odd. So to do any good buying for this stock, it has to fall now to lower levels for some strength to be achieved. So the nearest support would be around this 250 odd level, which is the top of the last candle. From there, one can hope for some entry here. Otherwise, this has got a vertical rise. It will also fall vertically. So that is the issue with these vertical rises. Now the Midcap index performed well and it has made a new high and it is doing well now here and crossed 50,000 and is now going up, and all the Midcap stocks did well. The small cap index, it corrected. So the broader markets were correcting last week. So it corrected now, but still it is not. It is still at that level of all-time high only. So we'll have to see the further movement from here. Right now, I think the profit booking has taken place due to weak hands, retail selling off, and all that because of the escalated prices. Now I'll cover three stocks today. The reason I'm covering these stocks in particular is that I'm looking for stocks where the risk reward is much favorable and those which have not really run up too much and where you can hold for long term. Now, first is Bank of Baroda. It's the second largest public sector bank in terms of assets, deposits, branches, number of customers and employees having a pan-India presence. Bank expects a credit growth of 12 to 14% for FY25, expected driven by 11 to 12% growth in corporate and 20% growth in retail. Deposit growth is expected to be at around 10 to 12%, so reasonable. The deposit growth and credit growth are generally close to each other. Net interest income grew at 2% year on year and 6% Q on Q, mainly led by sharp improvement in margins due to strong recoveries. Net interest margins NIMs improved by 17 basis points Q on Q to 3.27%. Core NIMs adjusting for recoveries were still up 5 basis points Q on Q. The bank expects NIMs to sustain at 3.5% in FY25. That will sustain their profits because in a falling interest rate environment, the NIMs are also expected to fall. The domestic credit deposit ratio stood at 82%, which is good. The bank is guiding for an ROA at 1.1% in FY25. So it will perform reasonably well over the next 1 or 2 years. Asset quality improved with GNPA and NNPA declining by 16 basis points and 2 basis points Q and Q to 2.92 and 0.68%. So if you see here, the net interest income has grown by 2% and 6% Q on Q due to sharp improvement in margins due to strong recoveries. The NIMs have also improved. If you see year on year, and Q on Q, year on year the NIMs have gone down, but Q on Q the NIMs improved. Now what the bank has done, in case if you see the NPAs, and ROA was around 1.3%. Now coming to NPAs, they have from 0.9 it has come down to 0.7. They have fully provided for the stressed aviation account, that is Go First account. And if you see here, the NPAs are declining and deposits are improving. Gross NPA is also declining. Hence, and PCR is good. So it is roughly 77% provided for. So it's not a bad scenario for them. Retail, agri, MSME and corporate lending is showing strength. Now, if you see here, for future, net interest income is expected to move around 10% over CAGR over the next 2 years. Similarly with net profit and EPS. So if you see the price to book, price to book right now is 1.3. Next year at present prices is approximately 1.1 and 1. So this is a reasonable level to buy this stock, considering forward earnings, and hope for 10 to 15% return. Reasonable return with decent, what should I say, a decent amount of dividend and etc. ROA is expected to be decent. Peer comparison, if you compare at these prices, the price to book for the Bank of Baroda and SBI is similar for FY25, FY26. ROE is higher for SBI, slightly higher than Bank of Baroda, and ROA is also generally the same. Return on assets is around 1 to 1.1%. So they are at generally the same valuations. So there's not much of difference. So as per your whatever you feel good, you can buy either one of these banks because they are both good and right now at not very expensive valuations. So now if you see the chart, it has had a decent rise. It went up and then has corrected to its 20 EMA on the weekly chart. So somewhere close to around 250, 256 is a good level to accumulate this stock. Right now, it is going up because there is a basic enthusiasm with PSUs, but there's a good stock to hold, and it will give decent returns. Now, the other stock is Interglobe Aviation. It reported EBITDA growth of 45% year on year to rupees 39.8 billion. So 1 billion is 100 crore. So roughly 3980 crores in fourth quarter FY24, while PAT more than doubled to 18.9 billion. Now, let me explain these terms. Revenue passenger kilometers was at 30 billion. Passenger load factor was 86.2% with available seat kilometer ASK of 34.8 billion. Estimate was 33.9 billion and a yield at rupees 5.2 versus estimate of rupees 4.97 plus 7% year on year. Now, you see the first terminology, revenue passenger kilometers RPK. Revenue passenger kilometer or passenger kilometer performed. It is one revenue passenger kilometer means one passenger is carried on 1 kilometer. So this is basically what revenue you have achieved. Then is ask available seat kilometer. Available seat kilometer measures airlines carrying capacity to generate revenue, multiplying the available seats by number of kilometers flown. So what is it is telling is what is achievable. So they could have achieved as per number of seats and number of kilometers they have flown 34.8 billion. They achieved 30 billion, and the ratio is the load factor. So this passenger load factor 86.2 is the ratio between both of them. So this is what it is. Now, management is confident of adding one aircraft per week on an average in FY25 with capacity and passenger growth guidance intact in mid-teens for FY25. The available seat kilometer ask is expected to grow 10 to 12% year on year in first quarter FY25. Now, the point is it shows how efficient this airline is because they have got so much of problems with so much of fleet is down because of that engine issue, and despite that they are able to manage aircrafts, turn them around, and ask is expected to grow 10 to 12% in next quarter. The 30-day domestic prices for Indigo are up 1% Q on Q at rupees 6438, and 15-day prices are up 4% Q on Q at 7123 in first quarter 25 till date. It announced a tailor-made business product aimed at redefining premium travel in India. So they want to start business class, I think, and so that will help their earnings. To capture the expected demand growth, Indigo has increased its fleet size to 367 in FY24 from 306 in FY23. It is working to increase its international presence through strategic partnerships and loyalty programs. Company served 106.7 million customers in FY24, that is 10 crores, with a net increase of 9 passenger aircraft. So that shows efficiency. Now we'll see their quarterly results. So this is net sales. Year-on-year change is 25.9%. Expectations was 16.7. So they outperformed in terms of net sales. EBITDA is variation of EBITDA that excludes the rental cost. So EBITDA was up 24.5%. This is in billions. So EBITDA margins are up 22.4%, below expectations. EPS approximately 49.1, again below expected, which was 61.5. But over FY24, they are getting an EPS of around 211. So 211, considering the monopoly status, they are roughly at around 20 times. Now, operational data, ask, as I have told already, was at 34.8 billion, load factor 86.2, and RPK at 30. Now, this yield, RASK and CASK I'll cover now again. So RASK is revenue per available seat kilometer. This is the total revenue which they have gained divided by ask. Then is CASK, CASK. This is cost per available seat kilometer. This is operating expenses divided by available seat kilometers. And yield. Yield is revenue divided by RPK, which is revenue passenger kilometer. So if you see here, they had a yield of per kilometer was 5.19. Revenue per available seat kilometer was 5.2. Cost was 4.61. So RASK versus CASK is 0.51. So this is they are making profit per kilometer, and ex fuel CASK is 2.87. So fuel cost is 1.74. So this shows their profitability metric. So if you see here, from negative it has become positive now, and this is the key issue. So over a period of, you can see this over what was expected and over FY24. So this is the factor which has to be seen for improvements and all that. So these are the ratios which have to be seen. So currently 70 to 80 aircrafts are grounded due to the engine issues, and despite that they are able to improve their available seat kilometers. So that is very good. So they have to manage their revenue per available seat kilometer, keep their cost low, so the yields will be better. So this is the basic philosophy of profitability of a airlines. So now if you see here, total ask is at 34.8 billion, up 14% year on year. RPK was 30 billion, which was actually achieved. This was possible. This was achieved. So up 17% year on year. So which shows that they are maintaining their efficiency. Now RASK is at 5.1, and that means revenue which they got per kilometer was rupees 5.1, and cost is 4.6. Load factor declined slightly from year on year, but better Q on Q. So to 86.2. Fuel cost is 1.7. So right now they are benefited because the fuel cost is less, but they have this power of pricing power. They will just put a fuel surcharge, so that takes care of their fuel issues. Now this is the present year issue. So profits are good and all that. Reported PAT, this is in billion. So they have reported roughly 8,000 crore profits. The revenues are expected to improve over the next 2 years, but profits are not expected to be improving right now because of additional cost and aircrafts servicing and all those issues. So one has to watch this stock right now. Now, if you see here, this stock has had a rise. It has constantly traded above the 20 EMA. Now it has gone up, but I think these are the levels not to be chased now. It should remain at these levels, 4,200 to 4,400 levels, because of uncertainties ahead with the availability and all that. Further rise would be constrained, but because of the monopoly issue, and now they are, I think, flying around 61% of the passengers and all that. So it should continue to do well, and with domestic tourism going up and all, so this should do well. And they are now improving business class also in their aircraft, so that should improve their revenues and profits. Now the last stock today is Gulf Oil Lubricants. Now this is again a very good stock to hold, especially from growth and dividend point of view. They reported a stellar set of Q4 numbers with EBITDA PAT growth of 37% year on year. It's second best in the last 8 quarters. Volume growth of 15.6% year on year was also solid, and it has been delivering as per management guidance of above industry peer growth over the next 2-3 years. Core lubricant AdBlue volumes. AdBlue is that diesel exhaust fluid used in vehicles with selective catalytic reduction technology to reduce harmful gases being released into atmosphere. So they're providing both the issues. Now both are equal now. 37 million liters they sold. So Go lubricants they sold 2.8% higher year on year, and AdBlue they sold 32.1% year on year higher. So broadly in line, but EBITDA margins of 13.7%, highest in 8 quarters, up 260 basis point year on year and 20 basis point Q on Q was a surprise. This is helped because moderate crude prices and aggressive premiumization of product portfolios helped superior pricing power for Gulf oil over the last several quarters. Now, this is a good part. Dividend yield is approximately 3.4%, and company aims to continue outpacing market growth by 2 to 3x over the next few years. Industry is estimated to grow 2 to 3% annually. So now if you see here, this is the fourth quarter's results. EBITDA margin was 13.5%, much better. And overall, as on year also, the EBITDA margin has improved from FY23 onwards. So that is good. Though revenue growth is in single digit, but EBITDA growth year on year is 31%, basically because of better margins. And PAT has also improved 37%. They did an EPS of, for FY24, they've done an EPS of around 62.8. And if you see here, core and non-core volumes were similar. So the non-core one is, that is AdBlue one is improving. And the interesting part is that the blended margin per liter are going down because the margins of AdBlue are lower. So, but just because they're efficient, that is hence even if their blended margins are going down, their EBITDA margins are still not are going up only, not going down. So that is the key issue. Now let's see their financial summary. Now, if you see here, the EBITDA is likely to be maintained at around 12.9% year on year. They're expecting around a revenue growth of around 10% every year, and EPS is expected to be FY26 is expected to be 17.9, that is 79.2. So that is approximately 80. So 80 at 14, 15 times is approximately 1200 to 1300 should be a decent price. P is right now around 13. So with net cash company with giving good dividends, it is relatively cheaper as compared to its closest peer, which is Castrol. Castrol is at 20 plus P right now. So that is the point. And this one is expected to grow faster. Rest are decent and 25% odd ROC, ROE, etc. So if you see here, strong volume growth, lubricants and total volumes combined and AdBlue. So strong volume growth. Fall in blended margins due to stronger low margin AdBlue volumes, which has lower margins versus lubricants. So AdBlue, and they are selling the same amount right now. Volume CAGR of 14.5% over the next 2 years is expected. And if you see here, revenue per EBITDA to grow at 10% and 12% CAGR over the next 2 years. So EPS in FY27 is expected to be 89 and 79 over FY26. And you see revenue and EBITDA both are going up only. Hence, and if the autos are going to do well, then these lubricants will also do well. Return ratios are healthy, ROE, ROC, so and they are expected to remain at this level. Strong cash flow with minimal capex outlay. So the capex expectation is low, and it has got strong cash flow. So one of the valuation which somebody has done, they have come to a figure of 1335, but this is based on FY27 earnings. So around 1200, 1250 is decent for FY26 earning wise. So So there is some upside possible. Present market price is around 1,020.30 right now. So there is some value here. Now, in what they are doing is they are doing aggressive build out of distribution infra, brand spend, new product launches, and new segment entries they are doing just to improve the products and the value added. Moderate crude prices and aggressive premiumization has helped superior pricing power. This has led to expansion of EBITDA margins. It is at steep discount to Castrol. FY24 dividend is rupees 36. So that's why I was saying around 3.6% dividend yield. And they took a price hike in core lubricant segment of 2%. Now, in my opinion, anything close to this 20 MA of 920 to 930 odd should be a very good level to enter this stock. Even now also, it went up, it has corrected, but that is all those weak hands must have gone up, and it has gone up last week due to on heavy volumes. So it should do well right now because the risk reward is favorable. I finished. We'll take questions now.